5 years before you retire and then 5 years after you are in retirement, there are a lot of critical decisions about your retirement income. Today, we're going to take a look at how is the best way to create retirement income. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Gold investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Vero. How are you doing today, Véronique?
I'm good, Mike. It's almost as we record because we always record this in advance. It's almost Halloween, and my kids are really excited. So maybe I'll have time to grab some chocolate from them without them knowing.
You have
We'll
to teach
see.
them the concept of taxes, right? So here's what you earn. Now here's what the government takes, and then here's what's left.
And today we're not going to talk about Halloween, listeners. Like, don't be scared. We're actually unpacking the key investment decisions every retiree must make to avoid costly mistakes. More importantly, to feel comfortable and stress-free about retirement. And this is often linked with income, right? So if you're within 5 years of retirement, or maybe you're already there and just starting, this episode could save your portfolio, like nothing less.
Yeah. I mean, I see retirement as a journey. I like to compare it to my RV trip of 1 year. When we left home, we actually used our existing pattern. So we thought we were just on a long vacation. But after a few weeks, we kind of realized that it was completely changing. Everything is not the
Mm.
same. It's not like you go for 2, 3 weeks and then you come back home. After 3 weeks, we were very far away from home, actually, and we were not about to get back anytime soon. So it was time to change our mindset, adjust accordingly, and realize that a few things that we used to do before were not useful anymore. And we had to change those habits. We have to change our mindset. And this is also the same thing with your retirement portfolio. Some of the things that you have been doing for the past 20, 30, 40 years are definitely good. But one thing that is changing for sure is you have to change the mindset between accumulating money and then start withdrawing from your investments, which is usually quite scary, quite uncomfortable. And a lot of investors do not even want to touch their capital and they just want to
Mhm.
live off the income. So we're going to touch that as well because there are multiple things that you can do. And of course, there's not one size fits all here. It's more about selecting the strategy and the plan that sticks to your values, how you envision retirement. And those are completely different from one person to another.
Right. So let's address that shift, that mindset shift. What does it mean when someone moves from the accumulation phase to the decumulation phase?
So during the accumulation phase, a lot of investors will be a little bit more willing to take risks. They won't think that volatility matters much. Actually, you will often see that when the market goes down by 10, 20, 30%, a lot of investors will say, oh, it's a good time to continue to dollar cost averaging. So investing more,
Right.
benefiting from those rebates offered by the market. But then the day that you stop adding capital and you see your portfolio going down, it comes with a different feeling. Now you
Hmm.
don't see those as a rebate or a discount. You see that as a direct attack to your retirement budget. And now you're starting to think, well, can I live off my portfolio? Is it going to work anyway? And this is why a lot of retirees or young retirees think about moving towards income solutions.
Hmm.
They want to generate income, just not touch the capital and live on that. And I totally understand the mindset shift, but I find this habit quite costly. Costly in a sense that first you may move towards something safer that is less flexible and will generate less returns. I mean, it's not the end of the world if you could sleep well at night though. That's a good thing,
Hmm.
but still you're leaving money on the table. But even worse, it may force you to not spend enough in terms of like not enjoying as much as you could with the same portfolio. And then a lot of people will say, but Mike, I don't care. I want to leave that to my children. And I'm like, all
Hmm.
right, so you're going to leave that to your children and they will receive that big fat check when they will be in their 60s. Because technically, I mean, I don't plan on living until 65. So if I live until 85, 90, 95, well, my children will all be close to retirement. And then what will they do? They're going to save that
Hmm.
money and pass that to their children. And in the end, yes, it's going to accumulate a bunch of wealth that nobody really uses until one person, one grandchildren will wake up and say, "Oh, thanks, family. I'm going to spend it all." And that could be a lot of fun for your grandchildren, but maybe you could have enjoyed the money, or you could have enjoyed it with your children and grandchildren at the same time.
Hmm.
So all those decisions and possibilities are on the table. And again, it's like not one decision is better than the other, but it's more just to open yourself to different scenarios to really ponder the pros and the cons of each scenarios.
And with that in mind, how should investors' mindset around investing evolve?
Well, first, I think you should give yourself the permission to spend. You work hard for that money, you make sacrifices, now it's time to enjoy. Now, when you're thinking about investing, the first thing that comes to my mind is why change anything? I mean, why, if you have kept the same investment strategy for the past 30, 40 years, why fixing something that's not broken? I mean, it's working, you have confidence in it, you're comfortable because you have like full ends on your strategy. Again, doesn't matter how you invested during your accumulation phase. It could be by doing like momentum stocks, trading penny stocks, doing like timing the market, dividend growth investing, ETFs, name it. It doesn't matter. You know what you do, you're good at it. And now you're going to change the entire strategy. Maybe
Mhm.
you can do some modification that makes sense. But besides that, I don't see the point of completely changing your investment strategy. Some people will say, oh, but I got super lucky. I got like 30% in my portfolio now is in Tesla because over the past 5 or 10 years, I put some good money on it. Now I'm about to retire and I want to reduce volatility and reduce stress related to that. And I'm like, yeah, that's great. But you made a good move. Good for you. Probably you didn't have a strategy though. You got lucky on a stock and then your strategy did
Mhm.
not include a way to manage your winner. And then you were just like, yeah, I'm going to let it run until I die. And then you wake up one day and just like, nah, I don't want to risk that anymore because now I don't feel comfortable having 30% of my portfolio invested in a single company. And I mean, it kind of like brings the urge to have a clear strategy. So you have like two types of investors: the one that just kept on investing, following the next trend or the flavor of the month. Well, then maybe, yes, you should change your mindset to actually have a real investment plan. But for those who
Mhm.
have been following like specific investment rules, I'm not sure it's worth it to change the whole thing, especially if you are on track to achieve your retirement goals.
Right. And by the way, listeners, I would like to quickly pause before we continue because I want to invite you to tomorrow's webinar about 6 retirement upgrades. So if you're getting into that transition to retirement within the next 5 to 10 years, or maybe just starting retirement, like I've said before, you don't want to miss this. So save your spot now at retirementloop.ca/webinar.
Yeah, I just want to add a few notes on the retirement upgrades. I'm gonna not going to tell you what they are, but I'm gonna tell you the questions we're going to answer during the webinar. So the first one is usually from many retirees or soon to retire is, do I have enough, right? I don't want to outlive my portfolio. So it's a
Mhm.
combination of like how much can I spend and can I retire today or like in 2 years? Then we're going to highlight how you can pay less fees because a lot of investors, they don't want to give all their money to an advisor or into financial firms that are selling products that, yes, they work, but they charge hefty fees. The third question is, how do I pay less taxes? Which seems to be definitely a big one. We recently
Mhm.
had a Looper show at Retirement Loop with Jason Heath from Financial Objective Partners, all about tax optimization and saving on taxes. And that was a quite popular show. Not surprised though.
Yeah.
We had a lot of questions. It's only normal. I mean, you have a big nest egg, you're about to retire, and you don't want to give all that money to the government. You want to enjoy that.
Mhm.
And then we come up with a twist about, yes, do you have enough to retire, but how can you spend more? How can you enjoy a little bit more of retirement? Going on like flying on first class or going on an extra trip or having like a cottage by the lake or whatever is your retirement dream. Then we go back into more down to earth question about what happens when the market crashes. Because I mean, we've been running on this crazy bull run since literally the financial crisis with a few pauses of like mini bear market, I could put them that way. But what happened if we are about to enter into a big crash? Like how your portfolio is going to end up and how are you going to manage through this? And finally, the question I see a lot once people have their plan, they have their strategy, now they wonder, how do I know if I'm okay? How do I know if
Mhm.
I done the right things and I'm actually on track? Because a lot of retirees, they have their plan, they know what they want to do, but they're not sure if it's exactly the right way to proceed. So we're going to cover all those questions, provide solutions, the most important part. And yeah, so we're going to have a lot of fun. I expect the room to be full, meaning like
Right.
500 live attendees. So make sure that you register and that you log in early for this one.
And like usual, there's always a Q&A session, so that's your chance to ask my questions. So again, retirementloop.ca/webinar. Can't wait to meet you there. So Mike, going back a bit to that investing mindset shift. So when that does happen, that's usually when people get attracted to fixed income. Is fixed income still a relevant part of a retiree's portfolio in 2025 and beyond?
Yeah, so when you're about to retire, you have like two big questions. How much can I spend? Do I have enough to retire? And then comes the fear of market fluctuations, obviously, because you want to have some kind of like a guarantee that you can follow a plan and get that income and not worry about anything. And fixed income products will bring that stability. We talk about like GICs, bonds, preferred shares. You will have like a more stable value of your investment. You have that comfortable income coming in on a scheduled basis. Most of it, you already know upfront how much is going to be, which is a lot different than investing in dividend stocks or mutual funds or anything else where the
Mhm.
distributions or the dividend could fluctuate over time. At this point, it's really stable. I mean, you lock in a GIC at 3.5% for the next 5 years. You know exactly that on November 15th of every year, you're going to receive that 3.5% income. So psychologically, it totally makes sense. If you lose sleep over your portfolio being down by 10%, the answer is you should probably go for more fixed income. It's probably relevant to your portfolio. It works kind of like a safeguard against panic. So you don't want to like start selling your portion of equity when the market is down thinking, "Oh, I'm done with this." Well, you could be done with this, but just wait until it recovers before you do that. If not, it's going to hurt your portfolio big time. I remember I used to work as a financial planner during the financial crisis of 2008. So that was a lot of fun, a lot of client meeting, and a lot of like the speech was always the same from my client and from myself as well. So the client was saying, I'm done with that volatility. I can't take it anymore. I want to get out. And my answer to that was always the same. If you want to do this, it's going to take 5 minutes to do the paperwork. You can sign, and then you're never going to speak to me again. And they were just like, oh, what do you mean, Mike? I mean, you're my advisor. And I'm like, no, I will not be your advisor anymore if you decide to leave and go into fixed income because you don't trust me, you don't trust my advice, and you don't follow what I'm telling you what to do. So only one person decided after this whole thing, and I've met with hundreds of clients. Only one, unfortunately, decided to sell at the bottom of the market, go 100% in fixed income. And I never heard of him again because I told him you're going to have to deal with another advisor. But one thing I'm 100% sure, it probably took him decades to recover because I mean he locked everything at like 4 or 5%. That was like the rates were a little bit more generous than they were right now. And then 5 years later, when he renewed his GICs or bonds, I mean all the rates started to be lower for. I mean we know how it went. 15 years of bull market, 12 out of 15 years of like super low interest rate. So definitely not a good thing to do. So I suggest that you do an investor's questionnaire right now to assess how you can take those kind of fluctuation before it happens so then you can modify your portfolio accordingly and not having to panic sell. But should you invest in fixed income as you're about to retire in 25, 26? If you want stability and you don't care how much you generate in returns, definitely.
Okay, but Mike, if the goal is not to go 100% in fixed income or changing our entire strategy, to what extent should we invest in GICs or bonds for those who want to?
Yeah, it's an interesting question because even when I will get to retirement, I will take a small portion of either GICs, either bonds, either high interest rate savings account. It's going to be like one or the other, but it's going to be like fixed income, short term cash, mostly to build this cash reserve, to bridge the gap between the portfolio income and how much I need to withdraw. So the goal is not to have like for 3, 4, 5 years of complete retirement budget. So if I want to spend $50,000 a year, you don't want to put like 150, $200,000 in cash, but you want to have a small portion to make sure that you're not getting caught into be forced to sell when the market is down. Then the extended role, if you want to go above the cash reserve, is to have some stability. So if your plan allows you to retire on a 4% expected return, for example, well, then you know you have a very solid cushion. And if the most important
Mm.
thing for you is not to generate returns, but rather have something like super stable, then you can increase your exposure to GICs and bonds. And it's going to make total sense because in the end, your goal once you're retired is not to beat your neighbor's total income, total portfolio, is to just retire, enjoy, and then feel good about it.
Well, this like perfectly opens the door to the yield discussion again. Many retirees get obsessed with high yield, especially when they don't have like a large cushion, as you just mentioned. So, is that a trap to get obsessed with that?
I really think so. First, going back to the discussion we had at the beginning of the show about not wanting to spend your capital, there is that. I mean, of course, you have $1 million. 20 years from now, you still have $1 million in your bank account. You feel good about that. I totally get that. It's nice. But then you want to live off your yield. And your yield is a function of one thing, the total return of your investments. It's not a function of anything else because the yield is
Hmm.
not something that is magic. It's actually just something created from your investment. So if your investment doesn't generate a total return that is of, I don't know, like 10%, it won't be able to sustainably produce a 10% yield. If you invest in stocks, it's about the same thing. If the company does not generate enough profit and the earnings growth is not growing fast enough, the dividend will not be sustainable. There's no
Hmm.
other way. If the company is not able to increase its earnings per share on a steady basis, the dividend will not increase on a steady basis. And if the earnings per share starts declining, well, up to a point, the dividend will have to be cut. So it's not safer. It's not like better to go for yield than for total return. Actually, it's kind of ironic because I see this debate like between income and like people that label themselves as income investors and the others that are labeled as growth investors, but there's no debate. There's only like total returns that will generate income at retirement. That's the only thing. Now, how
Hmm.
you generate the income will be part of another discussion, but in the end, that's the only thing. So a lot of investors will say, but let's say you don't live off your income and you're not living off your yield. What if the portfolio goes down by 20%? Well, I already explained that I would use the cash reserve to compensate for that. So that's an easy, super easy answer, like not even have to think about it. And the other thing that you have to wonder is, all right, so what if the market goes down by 20%? What creates such a market drop? Well, the economy is not doing well. That's obvious, right? It's not just, oh, the market is going down for no reason. No, no, no. If the market it goes down by 20, 30, 40%, it is because the economy is in a recession, that people are losing job and eventually like obviously companies are not making that much money. A lot of them.
Hmm.
A lot of companies are struggling and not making a lot of money. What do you think is going to happen with your dividends? The same thing. So, yes, your stock price will drop by 20% and you feel bad about it, but the dividend is not too far from being cut at this point. And we can go back to 2022, to 2020, to 2018, to 2008. All those market drops were also bringing companies to cut their dividends. It's just normal. The economy slowed down drastically. People lost their job. They stopped spending as they used to. So businesses saw their revenue decline, their margin being pressured, their earnings going down, and eventually the dividend is getting cut. So if you were living
Hmm.
on $50,000 a year in dividend or distribution or whatever you call it on the yield of your portfolio, maybe your yield now you're not making 50K, you're making 47, 45. And what will happen with inflation? Because your portfolio is not generating the same amount of income today, but you cannot turn around and buy something else. I mean, all stocks are down 20%, not just the growth stocks, but the income stocks as well. So you look
Right.
for other options and you get stuck. And now you need this portfolio to grow income to recover from that cut. How it's going to happen? Maybe it will, but you have to consider this and just want to highlight that one is still in function of total return. And if the economy goes well, well, income products will do well, growth stocks will do well. But if the economy is going down, well, the market will follow, and so the distributions and the total return.
Well, Mike, if it's all related to total return, would you explain why a low yield, high growth stock might actually be safer in the long run?
So I tried this. I did a case study to celebrate the 10 years of dividend stocks rock in 2023. So I created DSR in 2013. And then in 2023, I decided to go back in time and see what was the great high yielders back then. I stick to the same strategy. So, I mean, in 2013, 14, 15, 16, and so on, I always been challenged by investors that say, yeah, but my portfolio generates like 7% yield. It's totally safe. It's all with great companies, and yours is only like 2% and it sucks. And I'm like, all right, that's fair, whatever. 10 years later, I've picked, the research was like 24. So 12 companies on the US market, 12 companies on the Canadian market. So 24 high yielders versus the 24 stocks that we used to follow back then and used to
Hmm.
like, based on a low yield, high dividend growth model. So companies that are actually yield agnostic, really. So, but just
Hmm.
focusing on those that are offering a little bit lower yield, but offering 5% plus dividend growth rate that is sustainable for a long time. And well, big shocker, 10 years later, the difference in terms of returns, in terms of income, that was just crazy. From the top of my head, I think that from the high yielders, it was like more than 50% of them either cut their dividend during those 10 years or did not increase it, like half of them. So if you're thinking about inflation into retirement for the next 30 years, well, whatever you spend today is going to, like, your buying power is going to lower by 2-3% every single year for 30 years. You're not going to be able to spend much in 30 years from now, even though you still generate the same $50,000 in income. So very important to keep that in mind, I would say. And the rationality in this, and you can download the dividend income for life guide. So from the case study, we created a
Hmm.
guide. We're going to put that in the show note. But the dividend income for life guide shows you then, okay, so let's dig into those companies showing low yield and high dividend growth rate. What do they have in common? And what do they have in common is quite simple: robust balance sheet, very solid dividend triangle. So the ability to generate more sales, the ability to generate more earnings. And of course, that leads to generating more dividends. So you have a business that has a robust balance sheet, that has plenty of growth vectors, that has good margin, generating more profit year over year. What's happening to those companies when we go into a recession? Yeah, their stock price take a hit, but they keep on increasing their dividend. And we have seen this many, many times in the past where great companies during tough market times, they keep their dividend alive, they increase it. And what happened after that? Well, they have survived the crisis and they thrive again. So, yes, you're going to make mistakes. I mean, it's not like, oh, I found the magical strategy to only pick amazing and winning stocks. I do make mistakes, but even in 2012, where I got Silogist, I got Algonquin that was really bad. And then not 2012, but 2022, sorry. So in 2022, Silogist cut their dividend, following in January by Algonquin cut their dividend in 2023. And yet in 22, in 23, in 24, my portfolio kept on growing and the dividend kept on growing. I did better in 2022 than the market. So I lost a bit, but it was better. And then 23, 24, 25, still positive. And even though not all my stocks are big performers and beating the market, which is impossible, the overall strategy was strong enough to sustain the returns that could have helped me retire actually on those years if I was about to retire.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then Under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now. And then give us a 5-star rating. Our goal is to help more investors just like you. So please spread the love. Thank you.
But Mike, let's be honest, like I've heard that comment many, many times, so I'm gonna repeat it, make sure that you have the chance to answer. So if investors are not generating their income from yield, that's like saying you need to sell shares. But I'm hearing listeners right now saying, Mike, I'm getting older, I want something safer, total return is not guaranteed. So what's the biggest misconception about volatility and total return at this stage?
And I've heard this so many times, and it's totally right. It's 100% right. Total return is not guaranteed. Well, what makes you think that distributions and dividends are? Again, they are a function of total return. So if you're saying that the total return is not guaranteed, anything else is not guaranteed either. So if you want safe, we go back to the beginning of this show and we talk about bonds, annuities, GICs, something that you have a contract and you have a predictable source of income that will be paid to you. End of story. If you go into anything else, if you buy mutual funds, ETFs, closed-end funds, or stocks, they will offer you a yield, but it's all related to equities. And if it's related to equities, it's related to total return. And that's just the way it goes. I mean, the industry is really strong, really great to package products offering you income. And it's great. I mean, that's retirees wants income. The industry wants to make money. Well, they just have to make a product selling income. I mean, totally makes sense. But
Right.
when you analyze how they create that income, I mean, obviously they have to make trades. They have to invest. I mean, they could write options. They could do a lot of things. But in the end, it's still the same concept of the investment firms will generate total returns and then they will package this into a distribution. So you receive the money. It's easier and simpler this way. But in the end, it's the same thing as if you have worked for an employer your entire life, you did not look at revenues, at expenses, and the net profit of the business. You just receive your paycheck. But the paycheck was a function of the business being sustainable and making money. Because if the business is not making money, eventually we'll go through layoffs and we'll cut down your paycheck down to zero. So there's nothing magical here. It's just the whole thing. So if you're saying that total return is not guaranteed, you're totally right. But you should also add total return, distributions, dividends are not guaranteed. And then you have the full picture.
Okay, so Mike, let's go back to the title, which was the best way to generate income. So walk us through how a retiree can actually generate income and without chasing yield.
There's nothing wrong about chasing some stability and higher yield. It's just to understand exactly what are the implications. So the very first step, even before thinking about the income, is to have a plan. You need to have a retirement budget. You need to have a financial projection. If you do not have this, it's like saying, oh, I'm going to go on a 1-year RV trip and my only preparation is having my keys in my hands and then starting the engine. Yeah, well, you're going to go somewhere, but I mean, how you're going to make it? Is it going to be a memorable year? Are you going to forget some stuff or make crazy mistakes? Probably. So you need a budget, you need financial projections. If you have not done this, stop listening, go do your homework, and come back for the rest of the show. Then you look at your current strategy. Why? Because, I mean, yes, you may be starting to retire tomorrow. So that's the part that is new in your life, but you have been investing for several years before that. So you have to ask yourself, okay, first, do I have an investment strategy that is clear? Can I summarize this into 5, 6 sentences, explain that to a 12 years old? Second question is, are you comfortable with that strategy? And it is possible that you decided, and I've seen that with a lot of investors saying, you know what, I'm going to take as much risk as possible. I'm going to be a bit cowboy with my investment, trying to crank it and hit as many home runs that I can make. But now that I'm about to retire, it's time to cash my gains and go for something a lot smoother and a lot less volatile. That totally makes sense. That's why you have to ask yourself that question. Okay, what worked for me that brought me to retirement? Is it something I want to continue doing it? Again, the best way, if you hesitate, the best way to do is just type investors questionnaire. Vanguard offers one online that is great. I mean,
Hmm.
it's always the same thing, 10, a dozen questions, testing you on your volatility tolerance, knowing if you are comfortable basically to lose money on the stock market. That's the gist of it. But it's going to help you build a better asset allocation. If you are comfortable, you don't even have to do that questionnaire and you just stick to your strategy. So that's the second step after making the budget and having the financial projection. Then you go and say, oh, now I need a withdrawal strategy. So I do have my
Hmm.
plan. I know how much I need. I know how much I want to invest. So how do I withdraw money from my accounts? That is a tricky part. And the best answers would be it depends if I have to give a general advice, which sucks. But that's pretty much it, right? So this is where you're going to do tax optimization depending on the type of accounts you have, depending on the sources of income you have at retirement, because you're not just going to have your investments. You may have like a pension plan, you may have like a CPP, OAS, government benefits, rental income, whatever, maybe an annuity as well. So you have to put that into play. And then you have to identify how much income, like real income, so interest income, distribution, dividend, is generated by your portfolio. And then you realize if you need or not a cash reserve, because if you need to sell some shares to complete your income, then you need a cash reserve. If you don't need that, well, then you're golden. You can live off. I got a really interesting discussion with a DSR members not too long ago. And he told me, like, I want to live off my income. I'm comfortable, like, not spending my capital. I've thought about that and that's totally fine. And I'm like, okay, great. And he's like, my portfolio generates about like 4% yield, like between 3.5 and 4%, great stocks, robust metrics. I believe them because between 3.5, 4, it's not exaggerated either. There are a lot of great companies offering you that kind of yield. And then I told them, well, then you seems to be very set. You're comfortable with your strategy. Your withdrawal rate is not dangerous, if we can put it that way, from a financial planning
Hmm.
perspective. It totally makes sense. And then you probably need a minimal cash reserve, but not much. And you're going to be able to actually do that and follow your plan. So this is how you get there, is to look into all the other factors that are around retirement. Same thing with the types of retirement income. You can see government benefits, pension plan, rental income as part of your fixed income. If you do a
Hmm.
global asset allocation, well, your portfolio could be in all equities, but if you have like a decent size of income coming from the government benefits and the pension plan, well, it's the equivalent of having a ton load invested in bonds. So you could also see it this way. So see that it's really case by case in terms of like how is your financial situation is built, but that could be quite interesting to consider other sources of income as fixed one. So then you can maybe take a little bit more volatility from your equity portfolio and expect better return.
Okay, but how do you blend like dividends, growth, withdrawals, fixed income, and all that stuff? Like you often talk about the cash reserve. How do you create that cash wedge to answer retirees' needs of income without sacrificing their retirement dreams, Mike?
So there are a lot of studies about having that cash wedge and say it's not optimal. And it's not optimal, and I totally agree with that. If you see that as, oh, I need $50,000 a year, that's 3 years of income of cash wedge, so $150,000 in cash. For sure, it's like 100% shielded. Like you're golden. You can go through pretty much anything with that kind of reserve. But the other thing that is 100% sure, that's you're leaving cash on the table. That's definitely.
Hmm.
So instead of
Right.
going for the full year of retirement income, why don't you just bridge the gap instead? So imagine that you have $1 million and you generate $30,000 in income. So could be interest, dividend, doesn't matter. It's like $30,000 that you do not touch your capital with that. So your gap is only 20K. And that 20K, make it 3 years to cover all kind of bear markets, like regular bear markets. Well, that's $60,000. So $60,000 out of a million, it's not that bad. And just to illustrate how like the expected returns on that, the difference, well, let's assume you retire for 20 years. So 60K at 2.5%. So very conservative in terms of investing in this into a GIC bond ladder or high interest rate saving rates. But let's say 2.5 for 20 years, that makes $98,000. So let's say 100 grand. So that would be the value if you never touch your cash reserve. If you had it kept that $60,000 invested instead, well, then at 7%. So again, being conservative on both sides. So not
Hmm.
going for the 12% that most people had over the past 15 years or maybe more, just make it like a little bit more average. Well, then it makes 232. So there's $130,000 difference between having a cash reserve or going all in into equities. It may sound like a lot of money, but 132 divided 20 years, that's like 6.6K per year. So almost $7,000. That's 0.7% of your $1 million portfolio. It's pretty much like a management fee. It's kind of like the insurance you pay to not get stuck into withdrawing money from your portfolio during heavy down market. And again, I want to say that because I cannot stress that enough. If you're telling me, oh, the solution was simply to invest at 5% distribution and that 5% distribution would magically increase to match inflation all the time, it would be 100% safe. I would argue that if you look into what happened during the financial crisis, those 5% yielders or those products generating magical returns, a magical distribution stopped paying those magical distributions because, again, the distribution, the yield is a function of total return. So if you cannot
Hmm.
generate that total return, the same problem is everywhere. So you want to withdraw 5% of your portfolio. You invest in growth stocks, you invest in income stocks, you invest in ETFs, or you invest in a mutual fund package for retirees with a fixed retirement date where it evolves using different asset allocation, all come down to the same thing. It's going to work as long as your investment generate 5% total return and you can withdraw 5%. Period. Was I
Hmm.
clear?
Yeah.
Just making sure.
So, Mike, what's the number one mistake you see retirees make with their investment?
I would say two things, actually. Either some people think they have to change everything because they're about to retire. They're just like, oh, it's a whole completely different game and all the rules are changing. And I'm like, not exactly this. Yes, the game is changing, but it's more like, oh, I'm level two. Like there's some stuff that changes, some others are the same. So don't start thinking you need to scrap your investment portfolio and start over again just because you
Hmm.
retire. What worked yesterday has a good chance to work tomorrow. So you may as well stick to something that you understand and you feel comfortable with. So that's number one. The number two is obviously one of like the main topic of today's discussion, thinking that the yield is safer or better than total return. It's a function. That's like your retirement budget, how much you will be able to spend for the next 20 years is just a function of how much your investment portfolio will generate as a whole. Math is math. We haven't find a way to twist the numbers and make them work in a different way. Mathematics are mathematics. They work right now. They have been working. There's no reinventing the wheel here. You may disagree with me because you're going to look at some products that have been created in the past 5 years where we are in one of the strongest part of the bull market that we've been running for the past 15 years. I mean, anyone, my dogs could have invested in the past 5 years and average double digit returns. I mean, my son Caleb actually averaged double digit returns. He started investing at the age of 10. So if you're thinking that your portfolio is great, I mean, well, it's as great as a 10 years old. So now we'll see if Caleb can make that happen for the next 50 years, 60 years of his life. I doubt it. I mean, he's going to have good returns, but at one point it's
Hmm.
going to fall a little bit, which is just normal. It's nothing against my son or my dogs. Even my dogs will have to think about their retirement at one point.
Mike, I would like to summarize like everything that we've said, but first, there's a sentence that you've said in a recent webinar that I would like you to include in that episode because I think it's worth it. You've said, those income products that are advised by some firm, they're not magical. The firms are selling shares. So you've said, DSR member, just be the firm. Like manage your portfolio like the firm would. So I think that's a very good image to share with listeners today as well.
Yeah, totally. I mean, the easiest way to generate income at retirement is really to be your own firm, your own portfolio manager. So I like to see my portfolio as kind of like a big holding company. Like I'm a mini Warren Buffett and I have like investment in all those companies. And of course, my like stakes are a lot smaller than Warren, but the point is the same. I mean, even if I own 0.00001% of a company, that doesn't matter. I look at it as, oh, I have those holdings and together they will generate enough so I can decide how much and when I withdraw money so I can create my retirement income. And I love to think that I am in control like this because then it makes my life so much easier. So if I need $5,000, I know exactly how to do it. I have a plan. I have the cash wedge. I know exactly the sequence of returns from like which account I'm going to withdraw the money. And then I get to decide how much I need to retire instead of letting the firm, actually paying the firm. That's even worse than letting the firm. You're paying the firm through management fees. So sometimes it's like subtle, like 0.50, 0.75, 1%. So you're paying a fee for the firm to tell you how much you are allocated. I'm not a kid anymore. Like I'm the one who's going to decide what's my allocation, not some investment firms deciding that the yield is this much. So this is how I like to
Right.
see investing at retirement.
All right, so now let's summarize all this for today. So here are the investment decisions you must make to generate like the best income that you can have. So first, define how moving from the accumulation phase to the decumulation one impacts your portfolio. Second, decide whether to include fixed income or not, and if so, to what extent and what's its role. Third, choose your balance between dividend yield and growth and what safe income really means to you. Fourth, ask yourself if your volatility risk has changed. And maybe, by the way, you could answer that investor's profile questionnaire at a very bad time, like on a bad day on the market. That would make the truth come out.
I love it.
At, at number five, determine how you want to generate income from your portfolio, be the firm. So, Mike, is there anything you'd like to add?
Keep it simple. Sometimes
Right.
we obsess too much about over diversification. We're going to talk about that next week actually, or
Mhm.
obsess over taxes. And it's kind of funny. I just ran like a financial projections this morning and changing the entire strategy of withdrawals, like completely adding more stuff and thing ended up creating $100,000 of higher net worth at the age of 100. So, and those were for clients that were in their 40s. So 100K in 40 years just to make it more complex. Yes, it's better, but I mean, dude, it's not worth it. Especially as you age. I mean, yes, when you retire, you're in like full control, you're healthy, everything is good. But as you age and you turn 75, 80, 85, is having a super complex investment strategy and a withdrawal plan will help you? Probably not. You want to keep things
Mhm.
straightforward and don't obsess over everything. Yes, you must consider taxes, you must consider the fees, you must consider a lot of things, but keep it clean is definitely the best advice.
And again, listeners, let's wrap this up by inviting you again to our sixth retirement upgrades webinar that is tomorrow, November 13th at 1 p.m. ET. Live seats are limited, so you can enter your name and email to get there live and also to make sure that you get the instant replay. Do that at retirementloop.ca/webinar. There will be a Q&A session after the presentation, so you can ask more questions about what we discussed today or, retirement and investing in general. Again, retirementloop.ca/webinar. So thank you, Mike, for helping us figure out what to do with our investment when retirement approaches. Listeners, remember not to fall into traps or to change your entire strategy. Also, again, save your spot for tomorrow's webinar, retirementloop.ca/webinar. For our show notes and related content, including the Dividend Income for Life guide that you can download for free, visit thedividendguideblog.com slash 253. Next week, we will go further into the retirement discussion with income products. So hit pause and the subscribe button now so you don't miss it. And until then, stay invested.
Stay invested. Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.